Good afternoon, ladies and gentlemen. Thank you for connecting to National Development Bank's investor webinar to discuss 2021 Q3 financial results. We have with us today our Director and Group Chief Executive Officer, Mr. Dimanta Seneviratne, who will take you through the presentation, which is to be followed by a question and answer session. GCEO will be joined by members from the bank's top management for the Q&A session. We would like to inform you that this session is being recorded for a playback video to be uploaded to the bank's website later on. On those notes, let me now hand over to Mr. Dimanta Seneviratne, who take the presentation forward. Thank you very much.
Thank you all. Welcome to NDB's quarterly update on our results, the investor webinar. So with me, we have members of the leadership team supporting me in taking any of the questions later on. So if you move on to the corporate profile, naturally, I mean, our vision is to basically driving force or financially empowered Sri Lanka. So 41 years in operation, we have now more than 3,000 staff. Fitch rating has affirmed A plus stable outlook. We are operating from 113 branches, 150 plus CRM and ATM machines, and more importantly through the NEOS platform. And naturally, we are quite committed to gender equality. We are the only bank, and for that matter, even only corporate with EDGE certification operating in Sri Lanka, and very strong governance framework. I think our achievements have been amply rewarded, recognized by many awards. The most recent one being one of the top 10 most admired corporates of Sri Lanka, organized by the SEMA and International Chamber of Commerce. In addition, the Global Finance USA, we were awarded as the best bank in Sri Lanka. And also the Banker Magazine UK, the Bank of the Year for 2020, this is for the second year. And Euromoney Magazine, again, our subsidiary investment bank, NDB Investment Bank, has been awarded for the 10th consecutive year. These are some of the noteworthy achievements. We move on to the next slide on operating environment. Of course, operating environment was very challenging with the country still going through the COVID waves, one wave after the other. We saw our economy picking up, coming off after the third wave of the pandemic. Though Q2 GDP growth rate was 12.3% as per the statistics department. Overall, the country's growth rate is estimated to be around 3.5% to 5%. We saw policy rates picking up. There was a policy rate hike as well. And ultimately now the current standing SDFR at 5%, lending rate at 6%, and statutory reserve ratio was also at 4%. And we saw money market rates getting adjusted right now. There's a anomaly in the short term and versus the long term curves. And we also saw a notable increase in the inflation due to food inflation mainly. And year-on inflation around 6.2% as per September numbers. So these are few challenges, major challenges that we have faced it. On the other side, there are opportunities as well, especially funding the export-driven businesses, funding the country's renewable energy projects, and also the SME after COVID were picking up. So we are quite geared to support them, fund them, especially in the import substitution activities and all. Let's move on to the other slide. Mainly on the financial performance, very high level. We had a total asset growth of 8% for the 9 months ended September, clocking 679 billion. Gross loans, we had 15% growth and we crossed 500 billion. Now we are at 509 billion as at September. Deposits grew by 7% at 526 billion. Profit attributable to the shareholders crossed 6 billion rupees with a 54% growth year on year. And post-tax profit up by 26% to again 6 billion. Profit before taxes, we had 16% growth at 9 billion for 9 months. So it's a nice 1 billion a month kind of a PBT level. NII, 17% growth of to 16.3. On the other side, on the balance sheet, the performance side, ROE of 14.07, improved from 2020 ROE of 13.13. Now this is with the rights issue equity that came in as well. So that is quite a good achievement with the higher capital base. Pre-tax return on assets also has improved to 1.75 from 1.59. NIM, net interest margin, also there's improvement from last year to 3.26. And one of the most significant achievement I see is the cost income ratio. One of the lowest in the industry, 33% versus 37% last year. Let's move on. Income statement analysis. This is more detailed analysis. You would see that interest income, 38 billion for this is quarter 3 cumulative Q3 versus Q3 this year. Interest expense 22.7 billion. There is both these, there is a reduction, though there is a growth in assets, mainly due to the interest rate reduction. But however, the net interest income, when you see that, you would see a good 17% growth from 13.6 billion to 15.9 billion. In the process, we have improved our margins as well, 3.26, and the larger decrease of interest expenses mainly due to the reduction in interest rates. One key area that I want to highlight here is the continuously improving the CASA ratio. We had 38% year-on-year growth and a quantum growth of 39 billion in current and savings deposit. So that is quite commendable for us with a branch network of about 113 branches. Moving on to the next slide. This is about non-fund based income. The earlier one is fund-based income. So there again, the fee revenue. This is again an area that under our new strategy we were focusing. 38% growth from 2.9 billion to 3.9, 1 billion growth year on year. And non-fund income base, again 12% growth from 2.9 to 3.3. So total non-fund based income, 25% growth year on year from 5.8 billion to 7.3 billion. So the main drivers of the non-fund income are naturally one is the growth in business volumes, but I think more due to the focused trade related operations resulting higher fee revenue there. Now this has been driven by our transactional banking unit and also a more focused approach on ensuring that we get trade income of our client. And also there's a good contribution coming from forex trading, the swap operations and all balance sheet management side. That has also contributed to this improvement in the non-fund income. So as a result, the operating income has improved by 19% to 23 billion. And the fee-based income has enhanced contribution to the profitability from the fee-based side. Moving on to the next slide. This is on the impairment analysis, impairment charges. We have been cautious and building up our impairment numbers. So that's 38% increase in impairment for the year. From last year, 4.8 billion for the first 3 quarters to 6.6 billion in quarter ending September. Sorry, the 9 months ending September. So that's 1.8 billion increase in the impairment charges. On the balance sheet side, the key KPIs on the asset quality. Compared to last year, again, asset quality remains more or less the same, 5.35% NPL ratio, this year 5.46. However, the improvement is on the net non-performing ratio. Net non-performing is non-performing minus the impairment provisions, specific provisions that we have made. So that has further improved to 3% from 3.23%. That also shows that we have been building up our provisions. We have been cautious and conservative in building up these provisions. The last two ratios are newly introduced ratios based on the IFRS accounting, which central bank, the regulator also mandated all banks to disclose from this quarter. So impaired loan ratio, which is the stage 3 loan ratio, is 4.49%. Similar level last year as well. And the other one is the stage 3 impairments to the stage 3 loans ratio. Now that has improved from 31% last year to 33.55%. Moving on to the income statement, the operating expenses side. Overall, there's a 10% growth in operating expenses from 7 billion to 7.7 billion, mainly coming from salary-related personal expenses, the staff development, staff training, all those activities. There's 9% increase. Then the other major one is on the other expenses, again 2.5 to 2.8, about 300 million increase. But all in all, more importantly, yes, cost is an area that we have to manage, we can manage, which is controllable costs. We have been managing it very well with the digitalization drives, workflow analysis. All that has helped us to curtail this cost escalation, even moratorium related and also the COVID related additional support that we had to give, additional healthcare services that we had to provide, the transport services that we had to provide to our staff. With all that, we have been managing the cost well, and as a result, the cost income ratio has improved to 33%. I think this is one of the best cost income ratios in the industry. You would see from 5 years back, it was around 49%, and how it has improved to current low level of 33%. So this is a focused area that we have been managing well, and we'll be focusing this on in future as well. As more we move on to the digital platforms, we should be able to get much better cost income ratio as we move forward. The next one is on the taxation and profitability level, again on the income statement. So there is naturally about 1.6% increase in taxes from 3.2 billion to 3.287, mainly coming from the VAT on financial services. So effective tax rate of 37%. For us, compared to effective regulatory effective tax rate of about 39 to 43% for the year. Last year, that was roughly about 49%. So all in all, effective tax rate as of now has improved to 37%. However, as you all know, with the budget proposals that have been passed, there will be much higher tax implications that would get addressed later on in this presentation. So profitability, overall profit before tax, we had 16% year-on-year growth from 7.7 billion to 8.9 billion. Profit before income tax, 16% again. Profit after tax, we had 26% growth from 4.4 billion to 5.6 billion. And profit attributable to the shareholders, more importantly, the PAS level, significant improvement from 3.9 billion to 6 billion. PAS also had some contribution coming from our subsidiary companies. Let's move on to the next one. This is on the balance sheet. Again, you would see healthy growth in the balance sheet despite the challenges, the COVID challenges and all. Total assets grew by 8% to 679 billion. Then on the gross loan side, we had 15% year-on-year growth from 444 billion to 509 billion growth. So this is despite all the challenges, this is quite a substantial growth. Industry growth rate is around 13-14%, so we are in line with that. Deposits, again 13% growth and crossed 526 billion. Borrowings and total equity, borrowings of course at a similar level. However, total equity you would see from 45 billion to 58 billion, roughly 13 billion growth in equity. This is mainly coming from the rights issue proceeds that we called in April earlier this year. The other thing that I want to highlight is the growth on the asset book is coming from all the business lines. It's a very well spread growth coming. And also the composition of the currency mix has further improved to 81% of the local currency, rupees to 19%. And this is something that we have been building on over the last 3-4 years to have a proper mix, making use of the local currency that is available. On the funding side, the deposits, it's benefited by many new products that we launched and also the convenience factor that we brought through the digitalization solutions. I mean, we didn't expand our branch network. However, we were keen in developing digital channels. So as a result, there was a lot of digitalization that has happened. At the moment, more than 80% of banks' transactions are covered through digital channels. So that has actually contributed to quite a good growth in CASA on the CASA current and savings account base, now at 141 billion for the bank, and year-to-date growth of 15% or about 18 billion. So CASA ratio also improved from 25% to 27%. One is the digital channels that has contributed. The other thing is the transactional banking and more focused approach from our SME team, corporate banking team, and also the retail team to get the operating accounts operated with the NDB, and that has helped us to grow this CASA base. Let's move on to the next one. So this is on the capital and liquidity position. Again, 9.63 tier 1 equity level compared to 9.17 previous year. And the total capital ratio at 13.63. This is as at September. However, with the debenture issue that's concluded yesterday, I must thank the investor community for taking our debentures. I think that was snapped up on the opening day itself. So we closed it yesterday itself and we raised 8 billion. That would naturally help to get the total capital ratio moving above 14%. Liquidity coverage ratio at 140%, quite healthy, and also the net stable funding ratio at 114.55. So we are meeting all the regulatory mandate ratios. Adequate buffers are also maintained, and I think capital level is quite strong. Let's move on. And this is on the investor ratios. Of course, the share price is something beyond our control. I mean, there's a certain control level that we can work on. So anyway, now it's at 76.4. Earnings per share, that has further improved to 26.26 from last year's 23 rupees. And ROE at 14%. ROA is 1.75. Book value of the share has come down from 192 last year to 163, mainly due to the increased number of shares after the rights issue. Price earning also due to that, so 2.91. Price to book value has remained around 0.5 level. Let's move on to the next one. Okay, so this is basically the coverage of the balance sheet numbers, balance sheet and the PL numbers. Let me now focus on some of the key strategic areas that the bank is focusing on. I'm pleased to share with you that we got the Great Place to Work certification, and then that's the award ceremony held yesterday. I think only local bank to get Great Place to Work certified in Sri Lanka. And I must congratulate the HR team and all those leadership team who involved. And it's a good achievement to be more than 3,000 staff, but everybody aligned with the strategy, everybody believing in the strategy and working together. I mean, that is why a Great Place to Work kind of a certification is coming in. So that's something that we want to share with the investor community. On the digital side, I mean, that's a key driver for the bank with the launch of the Voyage 25 new strategic plan up to 2025, where we have this plan to double our asset base and also triple our bottom line. One of the key driver is the digital banking side. So you would see that even our branding, all our branding also changed to ensure that we showcase our digital focus, where the branding goes as the future is banking with you. So in line with that, we launched several new products using the digital channel. NDB Neos app taking the lead. I must also share that NDB Neos app up to October, quite a substantial intake of transactions. We have transacted more than 100 billion rupees over the last 10 months. So that also shows the confidence that the users have placed on the Neos app. And we have taken the app to the different levels. Now we have also introduced Neos Biz, which will be launched this week with the regulator approval and all. This is the first mobile app available for SMEs to do their transactions. On the success of the normal Neos app for the retail customers, we launched for the SMEs the mobile app. Then we also successfully launched the VKYC virtual KNUI customer onboarding process. So a customer can, without stepping into the branch, can now open new accounts with us, and that has been also tremendous success. We see a lot of traction there, many new accounts open, not only in in Sri Lanka but also overseas customers. Even in Sri Lanka, we have seen a lot of people living in remote areas who didn't have access to the branch network now opening through this. So that's nice to see that development happening through the virtual KYC platform. And the other thing is on the crib integration. We were the only bank so far to integrate with the crib, so that a customer can take your crib report using our Neos app platform. Apart from that, we have linked up with our crib score, so that even the loan processing, we can get the crib score using this module. New products that are being launched on the NDBC, that's for the millennial NDB has the largest privilege banking portfolio in the country, and we saw there is a need to further segregate this high-end market So that's where we came up with the Privilege Select Plus proposition, offering a gamut of services, including the private banking arrangements, advisory arrangements, and all. And the other one is the NDB family banking concept that was launched a few months ago, again making good progress, ensuring all the family deposits are aligned so that we get the best to these clients where the entire family is banking with us. Banking on Women is doing very well. There's something that we introduced 2 years ago. Now we are in the second phase of Vanita Abhimani Awards program as well, phase 2 underway. We have also introduced a new category to recognize women in business, women in professional services also to be recognized through this awards program. Great success last year. So with that success, we launched it for the second time. And also, as I mentioned, the recent accreditations, Great Place to Work, Most Admired Companies, on the winner, the top 10 companies. So these are some of those key updates. Just want to leave it with the investor community. Let's move on to the next one. Okay, so a little bit of way forward, just to give some thoughts to you all on the new taxes being proposed. As you all are aware, the financial services VAT got increased from 15% to 18%. This is effective from January next year. And also there's this one-off surcharge of 25% of the profit in any company over 2 billion taxable income are now supposed to pay 25%. This is based on the financial year ended 2021 March. So accordingly, NDB also is supposed to pay this tax. So that's again a substantial outflow from the capital. In addition to that, the social security contribution of 2.5% of the turnover. So that is also from April next year. So we had to basically follow on that. So all in all, the effective tax rate has gone up to roughly about 45%. But with the one-off tax of surcharge of 25%, next year the effective tax rate would be roughly around 70%. So this is a big challenge. I think time to time banking system has become one of the major revenue earner for the government, and it's easier to tap the banking system to collect the revenue. However, the impact would be on the capital side. Not only us and the entire industry, I think almost all banks except for one listed in the stock exchange are supposed to pay this one-off surcharge. So that would have some impact on the ability to fund future assets because it's getting impacted from the capital, and also when the country is coming up from the COVID moratoriums and all. However, on the other side, we had to meet this burden as well, cover it up when the country needs certain funds. So that's on the new taxes. Of course, the budget also had several other key proposals, especially on the encouragement of establishing digital branches, digital banks. So this is a new opportunity that NDB is quite keen to follow. And this is where NDB having taken the lead. I think we should capitalize on that, especially when the budget also support that. Green Agriculture Development Act will be introduced that would also have an impact on customers in agriculture side, the smart agri products, and also that's aligned with our ESG practices. So that is again good to see that. And also to support the export-oriented economy, there are incentives that are being proposed. Now, this is something that NDB also started with the launch of Jayagamu Sri Lanka project last year. And we have several young exporters, new entrepreneurs lined up with that program that would also help, and that is in line with the budget as well. The other one is on the Sri Lanka to be developed as a wellness tourism hub. again an area that goes hand in hand with our business imperatives, especially on the exposure to the tourism sector and all. And also that in line with SME, where the customers are encouraged to have the homestay arrangements, and also naturally it's an area that we also can support in driving that key growth area. Uh, let's move on to this probably is my last slide. This is on the way forward, now strategic drives. As I shared with you, we launched our new strategy V25 a few months ago. So these are the key pillars that we are working on. One is the digital drive. So all our customer solutions are provided through digital channels. We are trying to ensure that we provide more through the digital channels. So as I mentioned earlier, about 80% of our transactions are now carried through digital channels. If you visit our branches or if you notice our branches, you would see that we don't have that much of a queue out there, customers lining up to get their services. That is not because we don't have enough customers. It is because the digital drive that we have launched, so that most of our customers are transacting through digital channels. So there's no need for them to come to a branch and do their transactions. And that continues to drive our cost income ratio improvements, and that is the one key driver that we are focused on. The cost efficiency is again an area that we are focusing on, again using the technology. Like I have mentioned earlier as well, we have now more than 14 robotic processors, RPAs working with us, and also on the workflows and all that have helped to ensure that seamless process improvements are provided using the technology as a backbone. So that has also led to a great cost efficiencies for a mid-sized bank, the best cost income ratio. Bank on Women is again a key area that we are focused on. There's dedicated people lined up. There's internal targets given to them to ensure that we get this women proposition empowered to contribute to the economy by providing advisory services as well as providing low-cost funding that we have received from several DFIs that would be deployed in these. Another focus area is the fee income side. Again, that you have seen the fee improvement in the fee income side. We have many strategies, especially on the transaction and banking side, the dealer financing, supply financing, ensuring that we have more fee-based revenue. Not that it is increasing the fee, not that, but more focus on some of the services rather than the income, interest income, to ensure that we preserve the profitability using these strategies. And another important area is, while doing all that, we also continue to ensure that our staff are kept very well motivated. They are given all the support, COVID support to our customers. National economic revival, we are supported even on the environmental side, protection, the reforestation, all that despite COVID challenges that we have continued. So this is, I think, all in all, a support from all our staff to get the bank to a level of this nature. Apart from that, we have lined up some funding lines to support our growth. We managed to get no fund coming in as a major equity partner with a 10% shareholding earlier this year. We also lined up some funding lines from DFIs, the most recent being Development Finance Corporation of USA, who has committed a substantial dollar line, which we are planning to have our drawdowns before the year end. So that would also be directed on some of these SME and Bank on Women kind of areas where we can basically drive that economic revival from those areas. So that's a little bit about the strategy. And with that, I conclude this formal presentation. And now we leave time for question and answers. So please feel free to raise your questions. So myself and my team are ready to take and clarify whatever the issues that you may have. Thank you. Erandi, if you can probably inform the audience how to raise their questions. We are yet to receive any questions so far.
Yes, yes. Could you please place the questions in the chat option so we can see it from here?
So far, we have not received any question.
Hello.
Yeah.
We note that certain participants are encountering a issue on their chat option, in which case we invite you to unmute and please speak up and please forward a question to the CEO or anyone in the panel, please. Thank you.
So we can unmute them, right? They can unmute themselves, Kumudari?
CEO, yes, they can unmute and raise their questions. And we do have someone raising the hand. Please go ahead and present your question.
Right. Thank you, Kumudari. Thank you, CEO, for the opportunity. Just want to understand what's your growth outlook for the next year, especially now with the vaccination drive and country pretty much coming out of the pandemic. And the second question would be, what's your rate outlook for next year?
Well, sorry, second question is not clear.
What's your interest rate outlook, sir?
Rate outlook, okay. All right. On the I mean, economic revival, certainly we are geared. Vachapani, thank you for that question. Quite geared. I mean, internally also we have ensured that our staff are adequately immunized and they are ready for the economy opening up. So right now, internally, we have more than 75% of the staff also immunized, and that way the staff precautions are all ready. But in terms of supporting the growth revival post COVID, we are quite geared. So that is why we are raising our capital side. I mean, even the debenture issue also, to ensure that we are adequately capitalized to support that, and we have well funded as well. Apart from that, the funding lines that we are lined up, including the DFC fund, that's again substantial funds, the long-term funds coming. So all that the funding lines also arranged to ensure that we are quite geared. We have on the other side customers coming out from the moratorium, some customers by this December. So there again, we have internally looked at all of them. Basically, their ability to come out from this situation, and the internal information so far is generally that we are okay. They have their businesses, but waiting for businesses to be recommenced for them to come and repay. So we are quite eagerly awaiting more support towards this sector by providing funding. With regard to interest rate outlook, probably Niran can add on to this question. Niran, our head of treasury. You can give your views, Niran, first probably, and later on I'll add on anything missing.
Yeah, if you look at the interest rates, I think the market rates have already adjusted somewhat. It's almost about 2 to 3. It moved up by about 2 to 3% during the very short tenor of last 2 months. So we feel that it might hold, even though there is room for a policy rate hike to come in, because there's a big anomaly between the overnight rate and the 3 months treasury bill rate, because there's a very big arbitrage opportunity also, because you can fund yourself at 6 and probably buy a bill for 7.5. So there is room for a rate hike, but even if it doesn't happen or happen, but we feel that the market rates should remain around the current levels, because we have seen it easing off a little bit of the very high levels that we saw. Even the long-term bonds, it has eased about 25 to 30 basis points, and some bonds have moved down by about 50 basis points. So we feel that overall rates should remain around this level and probably stabilize here. Thanks.
Thank you.
CEO, we would like to draw your attention to the question available on the chat, please.
Sure. I can't see the question. If you can read that.
Request asking for the surcharge, the tax impact to the bank.
What's the surcharge amount that NDB would be liable to? So I think that's roughly about 2.5 billion. So Indrini, can you elaborate more on that?
Yeah. So the surcharge will be on the liable income tax base. So based on the estimated profitability for 2021, that's from January to December this year, it will be in the range of around 2.5 billion.
That's another question. How are the banks facing in the current exchange rate situation? Of course, it's quite a challenge. I think all the banks are faced with this current exchange conversion issue. It's a culmination of several issues over a year or so. As you all aware, the country's balance of payment gap has been widening, though we may have 12 billion imports, $9 billion exports, as a 3 billion gap always. However, earlier with the tourism income that used to support that, but the tourism income almost zero for last 1.5 years. There is naturally that gap. So that's culmination of that. On the other side, the exporters, there is a growth in year-on-year growth in exports, but however, the conversion of those export, the level of which that we were expecting has not happened, where naturally their expectations were currency to depreciate further, so they were holding on to it. And to add to that situation, the interest rates prevailed in the rupee and the dollar deposit side also aggravated that problem. You may recall that few months ago, there were dollar deposits taken at around 6-7%. So some exporters, there was naturally no need for them to convert dollars, because they had the opportunity of borrowing in rupees at even 5.5-6% rather than touching their dollars. So all culmination of that had led to this current situation. But however, with the new directions issued by the central bank, now this is something as banks we have been pushing the regulator to issue. That was so earlier there was a 25% compulsory conversion that brought in. The new direction is much higher based on the net value addition in the export side to convert into rupees. So hopefully that should further improve the situation. So in the meantime, it's a bit of a challenge, but we are also prioritizing to the clients the key areas like education, pharmaceutical imports, essential commodities, all that we give priority when we have to basically use our dollar import side and rationalizing and providing the support. It's a challenge, but I think we have been managing it so far. There's a whole heap of questions that now have come in. Okay, one from what is the accounting treatment for the surcharge? Will it get accounted in 2021 financial year despite being retrospective tax, or will it get adjusted in 21 profits? So, Anthony, can you clarify that?
Yeah, the tax is applicable for the year 2021. From the discussions we have had, we feel that it will be liable for 2021, and then it would be a deduction from the profits for the year 2021. But of course, the accounting firms are having discussions to apply a appropriate accounting treatment and to see whether we can take it retrospectively. But this is a tax that came into effect this year. So it's most probably it will be liable for this year.
There's one on turnover tax, 2.5 turnover tax. Will it be on interest income or NII?
Yeah, the current, as per the budget proposals, it's on the gross income for a bank, and therefore it's interest income. But when they formulate this or the as per the inland revenue, I think we will have to have discussions and consider NII because the bank's interest, there is a large amount of funding cost. But at the moment, gross income is on the interest. That means it's interest income for a bank. So we need to get more clarifications on this.
Okay. There's another question on the debentures. I mean, also you just concluded the debenture. Do you have any plans for debentures again, as NDB had issued back to back from 2019? Probably not at the moment. We will watch for the how the interest rate situation is developing and then decide on that, but not for the moment. We just concluded a raise of 8 billion. That would also help to improve the capital side, but also some of these debentures were issued to replace some of the maturing debentures as well. There are some few maturities coming up towards the end of the year. So this will ensure that those are get replaced. There's another question on what percentage of loan book is currently under moratorium, and what is the total moratorium exposure in the tourism industry. Apart from tourism, what are the main sectors still under moratorium facility? So I think overall the exposure under moratorium is around 17%, which includes the tourism sector moratoriums as well. Tourism industry, we don't have much exposure. I think I have shared this earlier as well. Of the total book, the exposure in tourism is around 3.5%. So the moratorium figure also roughly 3.5% of 17%. There's another question on with the 8 billion debenture helping to strengthen the capital adequacy ratio. What kind of prospects are you looking at in terms of future expansion? And again, I elaborated more on this. This is in line with our strategy, growing our book, so doubling the balance sheet, and in the focus area, growing our fee-based revenue and all. So all that would be, so this capital that we are raising would be used for funding those. Last question on currently bank has around 150 basis point tier 1 buffer over the current requirements, while 100 basis point over the Basel III. And with the surcharge also impacting the tier 1 base, will there be any equity raising, or will there be slow in the book expansion, or the bank will manage through earnings? I think we should be able to manage through earnings, but certainly there'll be an impact with the surcharge coming. We have estimated roughly, Suendri, roughly about 40 basis point, 40, 50.
Yes, in the range of 50 basis points.
Yeah, so still the cushion is adequate to cover that. But I don't think we have plans to raise capital in the near future. So we should be able to manage it with the book expanding and the retained profits. As a question on if there's a 50% haircut on sovereign bonds, what would be the write-off amount for NDB in terms of its investment in sovereign bonds? First of all, I don't think we expect any 50% haircut on sovereign bonds. I think ability to pay the bonds, we have been assured that the reserves are there and there are plans to pay that. However, in case there's a haircut, Niran, would you like to take that question?
Yes, we of course rightfully think that it will never happen. But of
Yeah.
course, it will be a significant amount, I know, but it will not only for the bank, but for the entire industry, probably would have a big, I would say, a significant impact to the entire industry, would say, because I think overall, about 30% of the entire maturity or entire holding is held with local banks or within the country. So if you're talking about a 50%, it will have a very, very significant impact, I would say.
Yeah. So there's a question on what's the exposure for ISBs and the maturity dates. So the maturities are long term, right, Niran?
Yes, it's fairly distributed. We do have some very long-term ones, and also we have a couple of small maturities coming up for next year as well, for both January and July. Both, yeah. But that is for the sovereigns. But ISB, sorry, for the SLDBs, of course, it's during the next couple of years or something, the maturities.
Do you see a further improvement on your cost income ratio note in the digital drive you spoke about? Is there further upside on this? I think that's something that we are quite keen to further improve. Naturally, with the digital drive. Deepal, you want to comment on that? Okay, Deepal seems to be not there. So certainly there'll be improvement. That's the drive, especially on the digitalization and the investment that we have made as well, that core banking upgrade that we'll be moving on to the new platform by probably early next year. Would also provide us a nice platform to further capitalize on this investment. So right from the beginning, over the last 4 years, we have made this decision on digitalized strategy. So the investments on the IT side have been significant, and what we are reaping benefits are thanks to those investments plus the operation, the streamlining the operation profit process. So we will continue to have that focus to have one of the best cost income ratios in the market. So that drive will continue. There's a question on impairment. Are there any impairment already taken for fourth quarter 21 in the context of a possible debt restructuring scenario and related to foreign bonds after the Moody's downgrade of Sri Lanka's rating? Suendri, would like to take that?
Yeah. So now the possible debt restructuring scenario, I don't think, I mean, there are discussions, but then that has not happened yet. Of course, on the Moody's downgrade, yes, there can be an impact. We are assessing it, and as an industry, we will discuss with the auditors and take in necessary additional provisions if required in quarter 4.
There's one more that came in. On your strategy, how do you calibrate same in response to sudden shocks like pandemic, forex, scarcity, etc.? Nothing you have set it to 2025. See, now when you plan strategy, of course, we leave room for these kind of shocks. I mean, even when you plan for capital, also you leave certain room for shocks. So similarly, in a strategy, one is a shock or a threat, but on the other side, that also creates opportunities. Uh, so you need to ensure that both are managed well. I mean, that is where we have been in this game for many years now, and we have seen ups and downs. We have managed even the banking, even during height of the war, where you had seen ups and downs again. But again, banking sector has performed well. I mean, everybody first concern last year was when the COVID outbreak came in. The first to get impacted was the banking sector. Of course, the customers first, but having exposed to quite a large lending exposure and all, banking sector is exposed to. But there again, banking sector took the lead by providing moratoriums, the COVID renaissance facilities, the access, along with the regulator who came up and pumped money to the system. Bank sector also took a heavy burden, even interest reductions, interest refunds, all that to support the customers. And that is where adequately capitalized banking sector has contributed. And for that matter, I think Sri Lanka's banks are very well capitalized. In the region, we are one of the few countries who are following Basel III guidelines to the word, even into the IFRS accounting to the word. Chartered Institute also very strong. So despite all those pandemics, I think we didn't adjust our books or we didn't do anything to undermine all those good practices. So actually all that had in good state in managing a situation. So there's adequate buffer that has been maintained to arrange to meet a challenge like this. So I'm sure we will bounce back. Last year, nobody thought that the banking sector will perform so well, right? Probably that is why surcharge tax is also coming in to support the economy when the economy needs it. But we will continue to manage even these shocks, I think. And that is how we have been trained. That is how we have been developed, even our teams also to manage these shocks. And that applies to not only the bank, even that applies to even our customers. I mean, there are customers also going through these shocks. So we have to how we help them during their difficult time, how stable we are to help them. So for that, we need to be stable. So then only we can put a helping hand to get them out from their situation. So I think we are used to it and we are quite happy to manage that kind of situations. There's another question. Okay, who can take this? Indika, Vinoj, can two of you who have large exposures, corporate and SME, can two of you take these questions?
Yes.
Yes, SME sector, the lower end SME sector, we see stress on this particular segment, especially transport related and of course the tourism related, we know, and even the construction related. These segments, we see a stress on this segment, and even mainly though some of the upper end SMEs managing it well, but low end SMEs we see due to the cash flow constraints, some issues they are facing mainly due to the restriction of the cash flow level.
On the corporate book, the corporate book has been pretty resilient, I think, during the pandemic. So I can't say there was a huge stress coming out of the corporate book. But maybe something to watch out is maybe the trading portfolio. That's something that we need to keep a close eye. But be very specific to the question, I think in the corporate book has been pretty resilient. I don't see any major stresses coming out of it.
Yeah, so Actually, again, our book is quite well spread, so there are no major stress sectors as such that we are exposed to. Now, tourism is one area naturally, but I think as I mentioned earlier, our overall tourism exposure is about 3.5 to 4%. And of that, some sizable part is also into Maldives, who has already recovered and doing quite well, much prior to us. So I don't think there are any particular stress sector as such, but each sector there are affected customers. So we need to ensure that we help them out and then support them in their recovery. So these are the questions that we have received so far. So in the absence, can we conclude this webinar? Kumudari, can we conclude this, or is there anything that pending with anyone else?
That note, I would like to conclude the webinar. Thank you all. Thank you for joining with us and raising your questions. We would like to inform you that our investor webinar for the next quarter will be held just